Well, that was short-lived. Stock markets had a ripper of a rally yesterday. In fact, the largest one-day move since the bounce from the COVID lows in late March of 2020. And today, it fizzles. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. As I was titling the upload of yesterday's episode of the show for YouTube, the question I posed in the title was, stocks surge, but is the move already over? And there was some feedback that came in. Some people thought, yeah, probably already over. Things are very bearish. And then some people were saying, well, isn't that a little bit too early to say, and isn't that a bit overly negative? We've just had this massive day. And indeed, it seems like, as it turns out, the steam has been lost. Now, it has been only one day. And so I think the question that we find ourselves with now is, okay, well, we've had a pullback. Is this truly the beginning of the next leg lower, or are we going to chop around here for a while and still find our way? And to help us make that determination, we actually have the last bit of macroeconomic data of substance looming here in the last hours of the trading week. And so we're going to unpack what's going on here in markets and see if we can't get a cleaner read on the swing that comes next. We'll start here with just the S&P 500 as a kind of benchmark. This is the weekly chart just to kind of anchor where we are. And we started the week saying this looked like the kind of spot here, referencing the swing highs from 2022, resistance now becomes support. And sort of thinking about if the markets were going to bounce, this would be the place to do it. Sort of the textbook backfill that you might expect. You have a massive rally, you have a massive correction in that rally. If you were going to find a point where the sell-off loses steam, this would be the place to do it. And indeed, on Monday, that is exactly what happened. We found a little bit of a floor, and in fact, I was a buyer. I was selling puts into that move because it looked like indeed there was some level of exhaustion. The news flow hadn't become any better, but the market stopped falling, and that seemed to signal that maybe the stock of negativity had been priced in. Then, of course, the following move was a ripper of a rally, as we were saying earlier. This dramatic surge was, again, the most intense move since the first lurch higher off COVID lows back in late March 2020. But I ended up getting out of my long positions after most of it. I didn't quite catch all of it. It ended up being something like an almost 10% move. I caught about 7 and some change percent of it, because where we ended up landing, and we talked about this on the show yesterday, where we ended up landing was right at the underside of the range that we cracked on last week's Liberation Day tariff announcement. That's this gap right here. And so it looked like we'd hit something of a wall and maybe stood the risk of a correction lower. And we discussed on the show yesterday why that level might hold, and indeed today it has. We have a strong move off that level back down. Now, obviously, we don't do enough technical damage here to, let's say, slide back toward 5,000 or something like this. So this may yet have room to correct further, and we may chop around here for a while. Who's to say? But the idea that yesterday's surge was going to find follow-through seemed suspect, and indeed it hasn't found that follow-through. And ostensibly, it makes sense why. The announcement yesterday that the rollout of reciprocal tariffs would be softened, that there'd be a 90-day reprieve for countries on paying tariffs above the new 10% baseline for everyone but for China. We got some clarification today that China's new tariff rate is 145%, which frankly, these numbers are getting so astronomical and so obviously bait for a negotiation that they might as well be a bajillion percent or something like this. But nevertheless, what that doesn't change is the reason that the markets started to sell off around sort of the broader rollout of the fiscal policy agenda. And that happened much earlier than all of this, needless to say, about mid-February. When it didn't happen was November, when the outlines were getting known, at least almost certainly. It was very clear that some amount of tariff increase would come at the latest in November when the outcome of the election became known, and clearly the markets didn't sell off on that. They sold off here, when the rollout of the agenda started to show up as severe deterioration in business confidence and consumer confidence numbers. And so what we see then with yesterday's announcement is a relief of the sentiment part of this. Obviously, that announcement in the Rose Garden last week did not imbue anybody with a sense of forecastability. What it showed was a phone board with bilateral tariff rates for a whole host of trading partners, setting up the stage for negotiation, but also telling businesses and consumers, you're not going to get certainty that you can extrapolate forward on our tariff policy until all these negotiations are done. Successfully, unsuccessfully is hardly the point. That they are not done and that there will be more time elapsed means more time that you have to hold back capital because you don't know what your supply chains are going to look like because the tariff regime remains obfuscated in practice. And so when you get that, you, of course, get this panic sell-off. So the comments yesterday about the slower, kind of softer on-ramping reciprocal tariffs, that helpfully tells the market that the administration is not impervious to market discipline completely. There's a sentiment improvement there. It helpfully tells the market that the hit will not be as great right away. That seems to improve sentiment. But the forecastability and the predictability that makes this an economic headwind, that wasn't addressed. And so today, the markets kind of end up soggy because the upshot ends up being a sentiment flash in the pan improvement and not something more lasting. And we can see the economic hit very clearly here. As we've said on the show before, this Atlanta Fed GDP growth model is a nowcast, so it takes in economic data as it comes out, which can be multiple times a week or even every day, depending on the data's cadence. And it's not important where its absolute levels are, whether the economy is actually going to shrink at an annualized rate of 2 to 3% or not. The important thing here is the direction of travel, because what we can see is the tone of the data going into the model. And obviously, since the middle of February, that tone is decidedly dark. So the growth scare and the uncertainty behind it is really, once again, reasserting itself after yesterday's sort of sentiment window dressing. We got a CPI report that, interestingly, gave us weaker inflation than anticipated, 2.8% on the core. That's the first time we've seen anything like that since 2021. The headline number down 2.4% versus 2.6%. So certainly disinflation gaining more momentum here than was anticipated. But it's really the internals of this report that are the most interesting. If we take a look at which parts accounted for the drop, we can see that the meat of the decline is in core services and in energy. Now, this obviously, the Fed doesn't have much agency over, nor really does it have much agency over the price of food. Those are set in global markets. This is why we pay so much attention to the core. But it is notable here that energy is, of course, a very cyclical sort of thing. And we've seen crude oil fall with stock markets in anticipation that there is, in fact, a recession that's gathering steam. But the most shocking part of all of this is this bar right here. We can see the meat of the decline in inflation comes from deterioration in core services. And this is a much bigger deal, although this move in energy obviously looks like it's similarly sized because, of course, core services is by far where the growth is. We can see that of the headline number here, the headline 2.4% inflation rate, 2.25 percentage points was core services. Goods side of the ledger is a rounding error. Food is basically unchanged. Energy, basically a rounding error, a little bit more negative. And so what we find here really is that the part of the equation where all of the growth lives is the part that's doing the weakening. Moreover, if we consider what these numbers sort of actually look like in context, this contribution to overall growth at 2.25 percentage points, obviously we're implying growth by looking at the price impulse and saying when there is a pickup in demand, inflation tends to go up. When demand weakens, things go on discount and prices fall. Sort of think of it as the core services sector getting put into the bargain bin, as it were. That's what appears to be going on here. That 2.25 percentage point uplift is, first of all, marking the biggest disinflationary impulse of the bunch, as we just saw, but more importantly, the weakest contribution to the overall CPI number since December 2021. That suggests that if everything else here is weak and anemic, and especially the good side of the ledger is weak and anemic, what we're watching here is growth decelerating. The demand pull on inflation weakening. So whatever concern the markets have about recession seem to be getting some validation here. We mentioned over the past several days that even though the tariffs might be seen as inflationary, broadly speaking, and the Fed has asserted this, and does make sense that if you increase the sales tax on imports, which is really what you're doing with this increase in tariffs, then the end sticker price for whatever thing is going to be higher. And nevertheless, break-even inflation rates, the inflation expectations baked into the bond market, they've been falling since Liberation Day last week, as if to say that the recession caused by this will be so severe that the drop in demand will overwhelm any one-off or temporary adjustment in prices because of the tariff itself, and ultimately will be disinflationary because the demand drop with that severity will overpower for a net disinflationary impact, and not the good kind, the painful kind. This seems to validate that idea. Interestingly, against this same backdrop, the stock of interest rate cuts priced in for the Fed has actually eased back a little bit. We started the week at 137 basis points in the wake of last week's fireworks. We've shifted in here to just about 100 basis points, a little bit more. So we've basically shaved the equivalent of one cut from the outlook. We've gone from 5 to 4. But what's interesting is that there's a sense of urgency in markets. 84 basis points are on the menu for this year. 19 for next. That is to say, we're leaning in the direction of probably 4 this year, maybe none next year. So if you kind of round off the 84 to 100, you end up with the markets are biased towards seeing the stimulus quickly rather than later. And that, of course, is a bit of a clash, a little bit more sense of urgency from what we see in the Fed's own forecasting. We saw they just updated this in mid-March. It's 50 basis points for this year, down from 4.4 to 3.9, and then 50 basis points more next year, down to 3.4. So the total tally here is about the same at this point. To see that with the data that we just got from the inflation numbers seems to suggest that what the markets do is they see the recession, but what they don't see is some manner of looming collapse or crisis, perhaps echoing the improvement in sentiment that we have right here. That is to say, in showing that market discipline does work, and the bond vigilantes are getting heard, more specifically, seems to have reduced some risk uplift in yields, as it were, and suggested that maybe the Fed does not need necessarily to go and do emergency cuts maybe as soon as May, that instead it's a recession around this uncertainty that we're looking at, as the markets were fearful of at the start of this whole thing in early mid-February, is more accurately timed. And what they see is then the Fed not really in a hurry, delivering ultimately a bunch of stimulus, perhaps toward the end of the year, in the second half, perhaps, but not really feeling like that they have to pull the emergency brake, as it were, on whatever volatility. And with that in mind, we get another piece on the story in consumer confidence, which of course has been a key driver of why the markets are so upset with this rollout and why they think it's starting to push the economy toward a recessionary state. This has been an early indicator of where the economic headwinds have come from, and we're going to get the latest update here. Not surprisingly, the expectation is that what the University of Michigan will report tomorrow is that sentiment continued to decelerate. That seems fairly easy to surmise and really shouldn't be market moving because it shouldn't really surprise anyone. We can see here from the polling aggregates that you can look at from different sources. I like to look at the one from Real Clear Politics. It seems timely and well constructed. We can see here that the president's job approval has increasingly deteriorated, basically since sort of mid-March going into April, for obvious reasons. All of the tariff drama, of course, is front and center through this period, and we can see the gap is increasingly widening in the direction of disapproval. So it seems only right that if you then polled those same consumers and asked about their sentiment, they were going to be downbeat. The real interesting part here is this inflation expectation. We mentioned that so much of the driver of sentiment declining has been the idea that what these tariffs will do is revive inflation, make things more expensive, and in that action make consumers gloomier for obvious reasons. And we saw that the jump here in the one-year inflation outlook was all the way to 5%, just a hair from the highs in 2022. That, of course, was the peak in the post-COVID inflationary cycle. But The difference between now and then, as we can clearly see from looking at the inflation numbers here, back then, inflation was in the realm of 8% at the headline. But now it is very clearly not that. So whereas before the markets might be forgiven and consumers might be forgiven for extrapolating inflation forward because it was already high, here this seems more an expectation of a change in the reality that is currently observed, because clearly inflation now is about half of this forecast. Again, the most recent numbers here, 2.4%. So the key thing for markets here may well be whether this number starts to come in and starts to cool off a bit, or it doesn't. And I think we can probably surmise that just as sentiment here probably deteriorated again because of what we're seeing here and all the drama around it, this number, in that it's driven by sentiment and not by observed reality, is probably holding somewhere near the same levels, if not higher. If it is higher, then it's probably not higher by a lot, because indeed people's reference point is a time when indeed the inflation really was much higher, but it's probably not falling off to any significant extent. And that might again dovetail with what we're seeing right here. That is, a Fed that isn't necessarily in a hurry to deliver emergency stimulus, but a Fed that is likely to need to wait a little bit at least, then deliver it once the growth hit becomes really obvious. The implications for the markets there are quite interesting, because on the one hand, the implication might be a longer on-ramp for cuts, and so the dollar might strengthen a bit off its dramatic lows hit today. But stock markets may be no happier, because what it would imply is that the recession that we've been worried about since mid-February will continue to build unchallenged, at least for now. And so the path of least resistance for risk, now that we've kind of gotten through the sentiment seesaw, might well be back in this direction, as the broader narrative, the longer term narrative, this more orderly narrative, becomes once again the path of least resistance. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes this the last show of the week. Macro Money is, of course, back next week on the very same schedule. I will be on with Chris for Futures Power Hour tomorrow, as I am every Friday. Back with Victor Jones and Tom for First Call on Sunday. Back with Chris for Futures Power Hour Monday. On with Victor for The Price of Truth on Tuesday. Writing for the news and insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Good luck out there. Macro Money's back next week.